Hello and good evening, everyone. Today webinar topic is related to the demystifying REITs. So for this, we have with us Mr. Bihari Lal Devra, Director at Abacus Asset Management LLP, an Indian-focused management firm with over 2 decades of experience across asset management classes. Sir has managed portfolio for corporates, family offices, and universal endorsements. A chartered accountant, CFA charter holder, and holder of multiple global financial credentials. He leads the AIF, PNS, and RIA verticals at Abacus, overseeing portfolios, analytics, risk framework, and strategic investment planning. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels, aims at enhancing the quality standards in securities markets. Now, before beginning the session, I will like to request all the participants to note some important points. First, the question will be taken at the end during the Q&A segment. Second, the all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on NISM YouTube channel. Now I request Bihari Lal sir to begin with the session.
Sure. Thank you so much. Let me share my screen. Can you all see my screen? So thank you so much, NISM, for hosting this webinar and allowing me the opportunity to delve into demystifying futures and options. Uh, a basic background of derivatives. Derivatives is a contract whose value is derived from the value of some other assets known as the underlying. It could be underlying could be a metal, it could be a stock, could be an index or otherwise. Derivatives are widely used for a variety of asset classes. You will find derivatives on gold, silver, aluminum, copper, zinc, energy, oil, agri-commodities such as wheat, sugar, coffee, financial assets such as shares, bonds, foreign exchanges, otherwise. Whenever the price of the underlying changes, the price of the derivative also changes. Now, within derivative market, there are three kinds of participants from a market standpoint. One is obviously your hedgers, which essentially they have the risk of underlying price movement, and hence they typically would use derivative to reduce their risk. Second is spectators and traders who will try to predict the future movements in prices of underlying securities and based on that view and take a position. And third is arbitragers who will typically try to find out there is arbitrage between two products in the same market or a different market, and then accordingly kind of do the trade from that sort of standpoint. From a commodity sort of derivative perspective, there are OTC derivatives, which are over-the-counter derivatives, which are privately negotiated, and there are exchange-traded derivatives, which are kind of more traded on exchange, where contracts and everything is all standardized, where clearing corporation guarantees contract performance. Today, we are going to talk more about exchange-traded derivatives from an Indian standpoint. From a derivatives benefit perspective, yes, it helps in discovering price discovery for actual valuation expectation of the contract or the underlying. It enables the transfer of risk from one entity to another, those who are looking to shed risk and those who are looking to add on risk. And it also enables the shift of unorganized market to an organized market from a government sort of or a financial system sort of standpoint. Typically, you would have looked at four different kind of derivative terms wherever you are trying to sort of look for derivative definitions. One is forwards, another is futures, third is options, fourth is swaps. From a forward perspective, again, these are mostly relevant for currencies and interest rate futures and maybe some commodities. But these are contracts between two parties to buy and sell an asset at a future date for a fixed price, right? And both parties are obligated to complete the transaction regardless of the market price as delivery, which these are usually negotiated bilaterally and traded over the counter. Futures is something which is traded on the exchange, on regulated exchange. The contracts are standardized. It is a simple version of forward trading on an exchange. Option is a contract offering the right but not the obligation to buy, or option to sell but not the obligation to sell an asset by a particular date at a specific price. The buyer of the option will pay the premium. The seller of the option must receive the premium and should fulfill the contract if exercised. Options are also traded on the exchanges, and we'll discuss more about it. Swaps are essentially agreements to exchange future cash flow based on predefined formula. These are essentially a series of forward contracts which are used to manage typically risk of interest rate, currency, commodity price fluctuations. In Indian context, both forwards and swaps are non-exchange, and futures and options are exchange traded sort of examples. And examples, similar to what I gave, if you want to enter into a forward contract to sell, some tons of wheat at particular price, which are going to harvest after some time, you can do it as a forward. Same thing, an airline company can buy a crude oil future to lock in fuel prices right now and hedge against rising oil. Because the moment the fuel prices rises for the oil, which is the underlying of the contract, the price of future will also rise. And whatever you pay during the consumption of the fuel will get offset by the profit you will make it over here. Third is options. When an investor buys a call option or let's say on a particular stock with a strike price of XYZ, if assuming that the price will rise, and if the price rise, the value of the option should increase and accordingly he should make that money. And same is the case with swap, where a variable interest rate loan enters into an interest rate swap to convert it into a fixed rate loan, providing sort of certainty in interest payments to that extent. Now, from an option perspective, let's delve down into the basics of options. There are two types of primary options which you would have heard in the market. One is your call options, other is your put option, and the right or the amount which you pay in order to buy an option is known as option premium. Typically, on a plain vanilla sort of contractual or terms perspective, an option is a contract that gives the holder of the option a right, but not an obligation to buy or sell the underlying asset on or before the stated day/day at a predetermined price. An option which gives the buyer and holder a right to buy. Now, the key word here is right to buy. The underlying asset is known as call option. An option which gives the buyer or holder a right to sell is typically known as a put option. So call option gives you right to buy. Put option gives you right to sell the underlying assets. Now, typically, when you look at the options from a valuation or from a profitability perspective, options can be determined to say that they are into three categories: in the money option, at the money option, out of the money options. In the money of the options are supposedly options which are in profit right now, can be exercised immediately. At the money options are neither at profit, neither at loss, and one can wait. And out of the money options are deep out of the money, which are not exercisable. As you can estimate, the in the money options will be more expensive in terms of premium. At the money option should be flat, and out of the money option should be less expensive compared to in the money option. Typically, if you have a longer view on the market or if you have less money, typically people will try to put in the out of the money options rather than in the money options. In the money options gives an option holder a positive cash flow if it were to exercise immediately. A call option will be said to be in the money if the spot prices is higher than the strike price. Spot prices is of the underlying index and strike price is the price which is mentioned in the contract itself. At the money option, like I said, would lead to a zero cash flow if exercised immediately. So in that case, both call and put options, the strike price is equal to the spot price. And out of money option, like I said, when the strike price is worse than the spot price, which means the holder is unlikely to exercise the option. And that is why the value of the option simply reflects the time to the expiry of that option, or time decay, as we call it, from a investor standpoint. In valuing an option, obviously in call options are valued at intrinsic value, which is essentially underlying stock current price minus the call strike price. So typically, if you have an option where your stock price, the strike price is 1,000 rupees and the underlying stock price is 1,200, ideally the option should be valued at 200 rupees, because immediately by exercising the option, you will be able to make a gain of 200 rupees. Similarly, on the put side, it will be on the reverse side. Now, prices obviously are a function of volatility, timing to the expiry, time to exercise, and some of those factors. They will determine, the intrinsic value, and depending on whether it is cheaper or expensive to buy or sell the option, people do take eventual the trades from that. Now, from a long only options perspective, let's assume we've given an example here of a long call. Let's assume that the strike price of the underlying which you have bought is 17,500. The premium you paid is 95 rupees. Now, in this case, as long as the index expiry value is below 17,500, which is the strike price, you are unlikely to exercise the option, because if the spot price is less than 17,500, you would rather buy it from the spot market and not from the options right, which you have to that extent. So you will find four columns here. At the index value at expiry is assumed from 17,100 to 18,000. You'll find the premium paid, which is minus 95, which is the standard premium across the same thing, because you just bought one lot. The payoff at expiry would be zero in case the value is 17,500 or below. and it will be positive in case it is more than 17,500. The profit on expiry is nothing but a combination of A plus B, which is the premium paid, and the profit which you have earned from that perspective. So in the first 5 cases, you will see till the time the option is at the money, the net loss to the investor is minus 95, and beyond that he starts making profit, which is there. A long call option helps you limit your losses, but potentially unlimited profit. That is what the payoff chart essentially shows you on the screen. A similar example on the short call, where you have a right to sell but not a right to buy. Again, we have assumed the same numbers. As long as the index value of expiry is different, you will essentially kind of make the profit. So in this particular case, we are sorry we are talking about short call here and not a put option. We will cover the put option in the next slide. On a short call, you are essentially sold a call. So you expect the stock to go down, and hence you sold a call option. And in that case, if the stock price goes down, the maximum profit you will make is essentially the premium. And in case the stock price goes up, you will essentially make losses, which is unlimited. And in this case also, short call, the losses could be unlimited, but the profit is limited to that extent. This is the long put chart which I was explaining. In case you have a right to sell, but not an obligation to sell. In this case, if the prices goes below 17,500, which is what you would expect, in that case, you will make profits. But if the index keeps on rising, the premium which you have paid for buying the put option, which is 150 rupees, will remain standard. So the maximum loss for the option buyer is the premium paid, but the profit is obviously could be on the other side. So if you're too worried about the market, if you're too worried about the index movements, you can essentially buy a long put option. Similar to the long call, long put, and a short call, there is something called short put, where you have sold the put, in which case you expect the market to kind of go up and not down. And in this case, obviously till the time market goes down, you would be in losses, and the profit would be limited to the amount of premium which you have received. So these 4 charts essentially shows you explanation with respect to how the payoff of a long call or a long put or a short put or a short call will look like from a mathematical perspective. Moving on, the risk and return profile of option contracts, if you were to compare in long only, long side of the options, typically the premium paid is your risk, because that's the maximum amount of loss which you can have, and the return is obviously unlimited. On the short side of an option, whether long or a call or a put, the risk is unlimited, but the premium received is essentially your return, right? So a long option position has limited risk, which is premium paid, and unlimited profit potential. A short option has unlimited downside risk. Technically, theoretically, you can argue it's 10 till 0, but limited upside potential. And a lot of long only players, typically who buy it for long term, will try to kind of look at these options to expand to their earning or arbitrage on some of the underlying holdings which they might have. From an option perspective, there are 5 things which one needs to be aware of. You have spot price, you have strike price, you have volatility of the underlying asset price, you have time to expiration, and interest rates, right? So the spot price of the underlying asset is the price at which it is trading in the market. The strike price of the option is the right or obligation at the price at which you can exercise it. Volatility is of the underlying assets. So if the underlying assets keeps on moving, like an index or a oil or a crude or otherwise, you will keep on kind of finding that volatility. Time to expiration is the time to kind of the number of days or the number of months left for you to exercise an option. After expiration, the value of the options would be 0, and interest rate as a factor would basically determine your borrowing cost to that extent. These 5 factors are essentially what one should look at from a fundamental parameter, no matter what options they are looking at, right? As I explained you, higher volatility would lead to higher premium, lower volatility would lead to lower premium. Typically, all other factors remaining constant, if the strike price of the option increases, the intrinsic value should decrease, and vice versa, the value should decrease. And same way for other sort of options to that extent. The effect of time to expiration on both and call put option is similar to that of the volatility of option. Generally, longer the maturity, greater the uncertainty, and higher is the impact, and vice versa to that extent. And interest rate obviously is a function of borrowing, and that will impact the option with individual stocks and indexes as well to that extent. On option Greeks, there are 5 Greek terminologies which are used by option traders. They are delta, gamma, theta, vega, and rho. and we'll try to kind of, demystify some of them. Delta, again, the symbol is given for delta. Delta measures the sensitivity of the option value with a given small change in the price of underlying asset. So if the underlying asset is changing, and depending on that, the amount of option, the value of the option change, that change is measured by delta, right? Or it can also be called as the speed at which option moves with respect to the price of the underlying asset. So the key here is sensitivity of the option price with respect to the price of underlying asset. Second is gamma. Gamma measures the changes in delta with respect to changes in price of the underlying assets. So how frequently, how fast the gamma, the delta changes, that is essentially gamma. So for example, I've given an example here. If a call option has a delta of 0.5 and a gamma of 0.08, it means that the small increase of say 1 rupee in the price of the stock will cause the option delta to change by 0.08. Thus the new call delta would be 0.58 to that extent. Theta essentially is a measure of the option's sensitivity to time decay. Remember, we talked about the time to expiration, and theta is the change in options price given the 1 day increase or decrease in the time to expiration. Vega is essentially, a measure of sensitivity of the option prices to the change in market volatility. As you will recall, recently there have been a lot of geopolitical events, given tariffs and wars and other things that leads to market volatility, and this market volatility leads to the sensitivity of option prices. So whatever is not related to, whatever is the sensitivity of option price, which is not related to the underlying asset or timing, essentially is attributed to market volatility. And rho is essentially the change in option price given a 1 percentage point change in the risk-free interest rate. So 5 measures we told you in terms of, the basics of options, and 5 kind of option Greeks is what one should remember from that perspective. These are measured, calculated, and available using variety of softwares, and people can also calculate it on their own. If I were to summarize it, delta is equal to change in option premium divided by, change in option premium per unit change in the price of underlying asset. Gamma is the change in option delta per unit change in the price of underlying delta. Theta is the change in option premium per change in the time of, per day change in the time of expiry. Vega is the change in option premium per percentage change in underlying market volatility. Rho is the change in option premium for per percentage change in the cost of funding of the underlying asset to that extent. Now let's move to forwards. A forward contract, like I said earlier, it is a bilateral agreement which is made directly between two parties to buy and sell on a specific date in the future at the terms which are defined today. These are widely used in commodities because you want to plan for your harvest season or your production or otherwise, foreign exchanges and interest rate markets per se. All the terms of contracts like price, quantity, quality, delivery terms, etc., are fixed on the date of entering contract. It's as good as a bilateral contract. The only thing is it is not standardized unlike a future, but it's more bilaterally negotiated. A major limitation for forward is one, because it's a bilateral contract, there is a liquidity risk. And because it's a contract between two parties, the settlement has to be done individually. Hence, there is a default or a credit or a counterparty risk, as you would call it from that perspective. The enhanced version of, forward is essentially futures, which is nothing but a contract which is made through a recognized exchange to buy or sell a fixed amount of quantity of the underlying asset at a future date at an agreed price. So if you try to kind of list the futures into exchanges, that essentially becomes a forward. Forward, if you try to list it into exchange, it becomes a future to that extent. So contracts between two parties, yes, for sure, but it is through exchange. There is a centralized trading platform. There's a price discovery through free interactions of buyers and sellers. There's a margin payable by both the parties to cover the counterparty risk. The quantity and quality is kind of standardized but is decided today. The limitations, obviously, that these are standardized contracts and sometimes they might not fit in to the requirements which you have, and hence there might be limited kind of flexibility which you have on top of that other administration cost, apart from the counterparty kind of margins which one has to pay. But other than that, future contracts works great out there. In terms of swaps again is a derivative contract where two parties exchange cash flows or liabilities of financial instruments. So typically it is based on financial instruments. These are mostly on over, the counters. Interest rate swaps are the most common forms where, fixed and variable rates, are swapped between people who seeks to kind of manage the interest rate risk. The essential feature, obviously, these are customized contracts because the liabilities are very different. These are over the counter, so these are bilaterally negotiated rather than public exchange. There is a cash flow exchange which has to happen in swaps. There is a notional principal which is kind of determined, but the notional principal is not exchanged. So if you have a loan of $1 million which you want to convert from fixed rate to variable rate, only the difference of that the streams of future cash flow will be exchanged, not the principal itself. It has a long-term nature, so they can also be kind of extended to longer duration, which unlike a future and option, you need not worry about rollover cost to that extent. And last thing is risk management and hedging. Swaps are a powerful tool for hedging against various risks such as fluctuation in interest rates, currency exchange rates, credit events, without getting into rollover cost from an industry sort of standpoint. Few examples of swaps are interest rate swaps, currency swaps, and credit default swaps. Interest rate swaps are mostly used to convert fixed rate cash flows or for floating rate cash flows or vice versa. Currency swaps are primarily, parties exchange interest and principal payment in different currency to exchange for the currency rate risk. And credit default swaps are essentially, when one party pays premium to kind of receive protection against the default of the borrower of the reference debt. So these are typically similar to your insurance contracts. These are credit default swaps and largely bought by people who have underlying credit exposure. Other swap limitations would include, counterparty risk, which is similar to forwards, lower liquidity, which is similar to forwards, market risk, which is because the value of the swap based on the changes in stock market conditions can be very, very different. And so there's a market risk over there. Complexity, unlike derivative contracts, they are highly complex and they're not straightforward and standardized. And hence, obviously, the complexity of the instrument is very, very different. Now, let us talk about some trading strategies using options. There are primary, 3-4 sort of type of strategies which you can kind of do. There are like n number of strategies. We are going to talk about 2 or 3 of them here. We're going to talk about vertical spreads, horizontal spreads, diagonal spreads. And let us take few examples and delve into what each of these would mean. Now, if you look at the, hold on. If you look at the slide over here, vertical spreads are created by using options with same expiry date, but with different prices, right? So the expiry date would be same, the underlying would be same, but the strike prices would be different. Now take an example, bullish vertical spread, which is built using calls. A bull call spread is created when the underlying view on the market is positive or bullish, but the trader would like to reduce the cost of its position. So he will buy the call with the lower strike price and he will sell a call with a higher strike price. And in case market goes up, then obviously, he can exercise his option accordingly, make more money. So from a long and short perspective, you have long call and short call. So for example, in this case, you strike price of 17,500 is long for you and strike price of 17,800 is short for you. The premium which you kind of, pay for the call is 185. Premium you should receive out of the call is 61. So the net outflow is 124. Let's say the spot is 17,500. As of the spot of 17,500, you will end up kind of losing 124 rupees. The moment the market goes up, which is the bullish scenario in this particular case, you will end up making more profit. However, because it's a call strategy, there is a limited profit and a limited loss position. In this case, the maximum loss you can have is 124 and the maximum profit you can have is 176. These are usually timed strategies also used by arbitrageurs in case they expect the markets to kind of go up to that extent. In the bullish sort of vertical spread, you can also make it through put options. In that case, you will short the put with the lower strike price and long the put with the, short the put with the, higher strike price and long the put with the lower sort of, strike price. And accordingly, you will receive, in this case, 125 rupees as premium and you will pay 34 rupees to that extent. And if you can see from the chart above, there is a limited profit and limited loss position. In this case, the profit maximum is 91 and the loss maximum is 409 to that extent. This is a very common strategy and one can run it on different kind of parameters if needed. Now you can also make a bearish vertical spread. Now, in case you are bearish on the market, you can kind of short, the strike price, which is lower and, long the strike price, which is higher. In this case, you will see that he has paid the premium of 61 rupees and he's got the premium 185 rupees. Now, if the market kind of stays falls down, he'll make a profit of 124. If the market goes up, his maximum loss is capped to 176 to that extent, right? So the maximum loss and profit positions are seen from this particular slide. A bearish vertical spread, if you want to do it through put options, you can short the lower strike price and long the higher strike price, and then obviously you will receive the premium 34. You will pay the premium 125. So the maximum loss in case market goes up, remember you are bearish. In the maximum difference if your market goes up is minus 91, whereas the market goes down, you'll end up making maximum 409 rupees to that extent. So this is also a limited profit, limited loss position. There are multiple positions which you can create depending on how the strategies work, and each strategy will have a payoff schedule which can be calculated. For the purpose of illustration of demystifying options, we are talking about simple strategies here. But if one needs to kind of get more into it, one should look for technical analysis and the things to that extent. Uh, Apart from vertical spread, there are horizontal spread, in which case the options are the same type with the same strike price, but different expiry dates. So you're kind of looking at a time spread or a calendar spread to that extent. And the rationale for horizontal spread is simple, that those two options will have different time value. And hence the trader believes that the difference between time value would shrink or widen as the time comes closure. And then you are kind of essentially defining the narrowing and widening of the difference of premium of two options, which will be your earning kind of capabilities to that extent. A diagonal spread involves a combination of options on the same underlying asset, but different expiry dates as well as different sort of strikes to that extent. These are more suitable for OTC market, but also for exchange traded markets which are happening. There are, like I said, many other strategies which can be implemented or as per the market condition or investor expectation. However, these are few common strategies which one can plan in derivatives to that extent. Now, one should ask in terms of what are the advantages and disadvantages of derivative trading. And from an advantage perspective, yes, it has lower transaction cost because you're not buying the full underlying. You're simply buying a fraction or the underlying derivative contract of it. The cost of the transaction could be very, very low compared to delivery. It is used in risk management. So a lot of people use derivative contracts, because they have a direct relationship with the price of underlying assets. So in order to hedge the risk, for the changing price of underlying assets, people do often use, derivatives to that extent. Market efficiency improves given that our trader kind of has been working for a few years now. It involves the arbitrage, kind of to play out from that standpoint. The price of underlying assets is determined because liquidity might not be there, but the futures can determine or options can determine the price of it. And it essentially allows a formal mechanism for businesses or investors to transfer risk to other parties, which they otherwise do not want to take to that extent. The disadvantages or the cons of derivative trading would include that it involves high risk. These are highly volatile contracts, and the value of underlying assets like shares, securities, etc., keeps on fluctuating independently or rapidly, and people need to understand the risk to that extent. From a counterparty perspective, the derivative contracts like futures that are traded on exchange are organized and regulated, and the counterparty is essentially through exchange. And sometimes when you're dealing with forwards and some of those things, those are not standardized, and hence there's always a risk of counterparty to that extent. And the last is speculative nature. People often use derivatives as a tool for speculation, often due to lower kind of lower understanding of risk and a high risk associated with them to that extent out there. So one should kind of be aware of the pros and cons of derivative trading out there. Now let us talk about few actions cases which have happened recently and how derivatives has been in the news. From a real world scenario, derivatives are very versatile. They are financial instruments used across industries to manage risk, and they speculate obviously on market movements, capitalize on price discrepancies, etc. I've given a small example of Starbucks here, and in order to stabilize the cost of goods, which could be essentially cocoa and some of those kind of raw materials which gets used over here, Starbucks hedges a substantial portion, which is 40 to 50% of his annual Arabica coffee bean supply using commodity futures, ensuring that predictable ingredient cost for the consumers. Now, if you've hedged it, you already know what the price of that is going to be. Any differences in the price, you can hold on and do not pass on to your sort of clients from that perspective. And this classic example of corporate hedging. Global manufacturer Tesla, they utilize this currency forward contracts to hedge against foreign exchange rate risk, especially because they have euro-denominated revenue, they have yen-denominated supplier payments, and the car might be in a different country altogether to that extent. So protecting reported earnings from the currency volatility is also one of the examples which is used it in real time from by businesses to that extent. The other common examples in the world of investment and trading, you will find, key investment gurus like Warren Buffett from Berkshire Hathaway. He has generated significant income by selling long-dated, out-of-the-money put options on major stock indices like S&P 500. This strategy collects premiums and allows Berkshire to acquire assets at a discount if the markets falls below, the strike price. In Indian context, long-dated options are not very liquid, so the maximum long-dated options you can find is 1, 2, and 3 months, which has some liquidity, and hence obviously there's the evolving space within sort of India to that extent. On hedge funds, you will often find that they will use equity index futures to quickly adjust their overall market exposures. If the market exposure is high or less, they might kind of, to quickly take exposure to S&P 500 or, reduce it to that extent. Individual investors, those who are kind of holding shares in tech companies or etc., if they are worried about, what might happen to the stock to that extent, they can cap their potential losses through sort of options to that extent. From a bank and financial perspective, obviously they have to maintain their interest rate cost. They have to maintain their credit risk swap, credit risk defaults, risk, and that can be maintained using derivatives. For insurance companies, they have a longevity risk, which is offering annuities and person getting exposure beyond their living horizon, and they can innovatively use swaps and transfer the risk, to an investment bank or reinsurance for a premium to that extent. Pension fund, again, with global asset holdings, pension funds often utilize currency hedgings like currency forwards or futures and to manage the impact of fluctuations on the international investments, and this protect their value as well as whenever they're converting into home currency to that extent. Some recent developments, SEBI has done a study on derivatives trading in India. They update this study almost every year. You can find the full study on SEBI website. Essentially, what SEBI does is, they look at the equity-linked exchange derivative market, look at whatever the transformation has happened, and, basis the data from exchange, they try to find out the average profits and losses and the lot size at which investors have made during last 1 year to that extent. Obviously aided by low user-friendly platforms, low entry barriers to the costs, real-time digital access, retail investors have started entering the derivative segment in record numbers, particularly trading index option contracts. And India's investment option contracts are probably, in terms of volumes, are one of the highest in the world to that extent. You have monthly contracts, you have weekly contracts, which are headlines and sectoral benchmarks like Nifty 50, Sensex, Bank Nifty, Bank X, etc. The trade, this trend marks a significant shift of participant profile in the Indian F&O market. But by July 2025, SEBI has already published this particular report, which you are going to go through. Now, if you look at the chart over there, and this, numbers are from 22 to 25, the net profit or loss in each of the year from derivative trading is obviously given over here. SEBI has found out that 91% of the individual traders have lost money in FY25. The average loss per person is 1 lakh 69 rupees, 1,10,069 rupees, which is almost 27% higher than what it was last year. The total retail loss for derivatives trading across the board for FY25 is 1,05,603 crores, which is up 41% for a year-on-year basis. Now, if you look at the quarterly profits and losses, again, you will find similar number in terms of average profit, revenue P&L and number of traders and so on and so forth. One should be very mindful with respect to being an individual, also try to kind of trade in derivative market, because the history says that the retail investors often lose money in these particular scenarios. The key finding, obviously, for the report, again, it's a very unique report. I urge all of you to go on SEBI website and read this. Majority of the retail losses were concentrated in weekly index option contracts. So remember, in between exchanges have started weekly option contracts for Nifty 50, Sensex, Bank Nifty, etc. And the number of contracts in these instruments show exponential volume growth, which were largely used for speculation and not for hedging from that perspective. Second is, the unique retail traders in equity index derivative segment dropped somewhere around 50% in the local in the period of December 24 to May 2025. And despite the decline of the above mentioned 6-month period, the participation is still 24% higher than what it was in 2 years ago. Traders with low turnover, which is 1 lakh and below, show the sharpest decline. Yet they represented the largest growth cohort over 2 years, which means newer and newer people are coming into market and trying to experiment derivative with their hard-earned money to that extent. SEBI has taken multiple measures to control, the speculation. They have kind of rationalized weekly index derivative contracts to reduce speculation expiry day trading. They've increased tail risk coverage on expiry days to better manage volatility and systemic risk. Realize the minimum contract sizes for index to limit over leveraging of low capital traders. Is standardized expiry days across exchanges, mandated upfront collection of option premium, removed calendar spread margin benefit on expiry days to curb misuse, and introduced intraday monitoring of position limits to prevent real-time breaches and ensure compliance throughout the trading sessions. These sessions have kind of had an impact on retail and the volumes, and we hope next year when SEBI does the study, they find less people indulging into it for only for the purpose of fun, but rather making money to that extent. The key takeaways from the session would be saying that, look, futures and options isn't bad per se, but it is not meant for thrill. It is not meant for daily betting. It is a calculated call in order to hedge or arbitrage or into transfer your risk, which requires deep thought process to that extent. Most people, as you can see from SEBI survey, 91% of the people are not making here. They are losing not just money, but also their peace of mind. SEBI's efforts are in a step towards the right direction and they are starting to show results already. It's high time individuals start thinking long term and consider professional fund management over DIY speculation. You can look at people who take derivative exposure, which are AIFs. PMS can also take it up to a certain extent or otherwise to that extent if you are keen on getting an exposure to that side. It's high time individuals start thinking long term and consider professional fund management over DIY speculation. And the result is there in front of you. And maybe spend a little less time glued to charts timing the market, but rather stay more time in the market. As you are aware, timing in the market obviously matters more than time in the market matters more than timing the market sort of together. With this, I will put the session to close and then open the floor for any questions. I request NISM teams to take any questions which might be there. In the meanwhile, can I request people to put in their questions on the chat box and we can kind of try to answer them one by one to that extent. There are a few questions on certificates. Yes, certificates will be available for this webinar after a few days. You can also watch the session on YouTube and later on the link will be posted on LinkedIn as well for the session. So there's a question on the, IV. IV is essentially the implied volatility, which is the option. Like I said earlier, implied volatility, impacts, the price of the underlying option. It is one of the 5 factors out there. If you go to, NSE or BSE website, you will find that implied volatility as a measure is given in these options. Higher the volatility, higher the impact, lower the volatility, lower the impact to that extent. The basic rules for options would include that it's a, option. It's not an obligation. And as long as you know that, and as long as you can kind of, work towards it, I think what you want to do will determine how, what you will get out of it. Precautions with respect to investing in swaps. Again, swaps are anyway contracts which are more bilateral and these are more driven by businesses. Apart from the contract, I think counterparty risk would remain your biggest kind of measure to that extent over there. The amount of people who have bought and sold the options that value is calculated and shown by the exchanges as open interest, and higher open interest can show you some light in terms of how many people are interested in those exchange. Say BSC, the exchanges also publishes a tracking mechanic called VIX, which is volatility index, which kind of also give you a number in terms of what volatility market is facing to that extent out there. Uh, I don't know about gaming, but options and futures have been kind of then in existence for ample number of years, and largely they were meant for people to transfer their risk or hedge their risk. Obviously, people have kind of started using these for short-term kind of phenomena or schema, which may or may not work to that extent, to that perspective. NISM has multiple exams for derivatives. In case people are interested in learning more, they should appear for those examination. You have examination on equity derivatives, you have examination on common derivatives, interest rate derivatives, etc. And one should look for those examinations with the which has all the new curriculum and might be helpful for sort of starters to that extent. There's a question on VIX and IV. VIX and IV are not same. VIX is essentially an index which is traded and which is available in the market. IV is specific to the option. What is the price of the option implied, the volatility which is underlying there. So they are necessarily not the same. Yes, certain investors like Warren Buffett might have called that derivatives are a weapon of mass destruction. But, so is credit card, so is, financial instruments, or so is any other thing which you want to talk about. Anything which is overused can obviously destroy. Anything which is used with a limited time frame, with a limited kind of mindset and only for the purpose of hedging or otherwise, can certainly kind of, give your results to that extent. There are multiple books on option trading. I would suggest that to begin with, you should start reading, the NISM workbook. That will give you a basic understanding. And then obviously you can explore if you want to kind of get into more understanding and deeper into what you might want to sort of understand or go from there. One should also look at options or futures which are available in different other markets. Or obviously you're looking at India market if it's available there. But outside India, the market might be much more robust or maybe much more liquid with volumes if you were to kind of trying to do that. What we have shown you here are some basic strategies. Of course, we are not an expert on options and we don't do it in day to day as a means for living. One should sort of, study and take calculated options accordingly. The options workbook is essentially a NISM workbook which is meant for an exam. So you should search for NISM workbooks which are available for free on the website. And once the link is out there, you can obviously put in your email address names and download that workbook yourself out there. Well, if you have gained good knowledge about derivatives, you can utilize helping clients. You can take an advisory license, you can take a research analyst license, you can join as a broker dealer at one of the places to kind of test your skill sets to practice and then go to that extent. The certifications from NISM, a lot of them are mandatory in nature, which means for a particular job like a dealer or otherwise, they are mandatory for you to clear. Similarly, there's a certification which is also required for distributing SIFs, which is specialized investment fund. And one should look at investment, the certification, not just from a knowledge perspective, but also to complete the mandatory requirements for certain regulated roles which are there in Indian capital markets. Okay, at this point in time, let me see if there are any more questions and then go from there. Okay, the recording would be available on YouTube and website, etc. We can talk about it and you can have a look at it. The certificates will get emailed from NISM email themselves on your registered email address. The SEBI report is essentially available on SEBI website, and SEBI updates it almost every year. And one should search for it and find out the full report to that extent. The certification required to distribute SIF is, I think, NISM exam 13, if I'm not wrong. One should search on NISM website for the same to that extent. The question is on futures contract different from a forward contract in terms of trading liquidity and counterparty risk. Well, in future, because it's exchange traded, the counterparty risk is not there because there is a clearing corporation which will settle it. In forward, that risk is there. A future can be traded anytime on the exchange, which means the liquidity is out there. On forward, that might not be there. And counterparty risk, obviously, the settlement cycle to that extent. So in futures, obviously, the price discovery is there because it's trading. In forwards, the price discovery might not be that efficient otherwise to that extent. Okay, there are no more questions at this point in time. Thank you so much, and see you soon on our next education webinar.
Yeah, thank you so much, sir. I would like to extend a heartfelt thanks for taking time and speaking at the webinar. The insights, expertise, and presentation as well truly made a lasting impact on our audience. Thank you so much, sir, again, for your knowledge and information, sir.
Thank
Thank you. Thank you.
you.
Wishing a wonderful day ahead, sir.
Thank you.
Thank you. Thank you. And thank you to participants as well for joining us today. Yeah. Thank you. Thank you all for
Thank
joining today. Yeah.